Very good afternoon to everyone, the entire team of Asset Management, our guests who are our esteemed clients, and the entire team of Ashutosh FinServ. Just to inform you that we are recording today's session and we will share the YouTube link of today's session with you. So just in case if any one of your friends or relatives have not been able to make it today, you will be able to share this link with them, and it is live right now. Also, thank you for sparing your valuable time and making here today. Also, thanks to the people who have joined through Zoom. I'll start by introducing today's speaker, Mr. Amit Ganatra. Mr. Ganatra has a vast experience in the field of investment management of more than 2 decades, working with multiple renowned asset managers such as Fidelity Investments, DBS, HDFC, as well as Invesco. He is a fellow chartered accountant and a certified financial analyst, CFA, by qualification. He is currently the head of equities at Invesco Asset Management and manages assets of more than 33,000 crore rupees in equity markets in India. Globally, Invesco is one of world's leading independent global investment management entities with close to $1.5 trillion in assets under management across the globe. On a lighter note, Mr. Ganatra's journey with the Indian investment management industry is similar to that of cricketer Hardik Pandya with the Indian cricket team. Just as all-rounder Pandya, who at a young age has delivered consistent performance in all formats, be it T20, ODI or Test cricket, Mr. Ganatra at a relatively young age has delivered consistent performance at various different roles in various different asset management companies through all different market cycles faced by the Indian equity markets in the last 2 decades. Amit bhai, it's an absolute honor to have you here today with us. Thank you so much for sparing your valuable time. Moving further, we will start with his address and followed by discussion with our MD, Mr. Dakshish Kothari, and myself. I'm quite sure that all of you would be having a lot of questions to ask him. Thereafter, we'll then proceed with the question and answer session. Without taking much of your time, let us proceed further.
Thanks a lot. Thank you. Thanks for your I can sit also? No, I can stand. So, thanks a lot for your kind address. What we'll do is So we'll start today's discussion by starting with global macro. I will just, take you through some of our thoughts on global macro. I'll also try and explain where India is placed currently in the global scheme of things. We'll also try and understand where valuations are. And hopefully if we, combine all three, then we will get a clarity in terms of, what we need to do currently as investors. So firstly, global macro, I think if I were to define this global macro in one single word, then the only word that comes to mind is uncharted. It's an environment where, honestly, none of us have had an experience of saying that we have seen this before. Why do I say that? The reason is that I was told that there are NRI clients that we have, right? Now people who have experience or having stayed in US, when was the last time when US had a mortgage rate of 8% and in India you can get a mortgage loan at 8.3, right? So this is once again unprecedented, uncharted, having not seen this before. The latest quarterly GDP growth rate numbers which were out, Japan grew by 6%. Now, many of them have not even seen this or read this. Why? Because we have stopped caring about Japan long back. Japan used to grow at 6% before 1980s. Post last 43 years, it has never seen growth rate of more than 1%. Right? Japan just locked 6% GDP growth rate. So once again, unprecedented, uncharted. All of the entire investment community in entire world, or all the economists in the world, have been waiting for US recession for almost more than 1 year now, and it just refuses to happen. Imagine that, for a recession which is yet to happen, US markets were already down last year. Right? So that has been the gap now in terms of market's expectation of a recession in US and actually recession happening in US. And even today, there is no clarity in terms of whether, there will be a recession in US or not. Our view on this is simple, that, see, recession or no recession, there are certain things which are facts, which are statement of facts, and that is something which will be relevant to all of us. So we don't know honestly, whether US will have a recession next year or whether they will not have a recession. What we don't know is, we also don't know whether, if they have a recession, whether it will be a very strong recession or whether it will be a shallow recession or whether it will be a mild recession. Honestly, we don't have answers because, as I told you, that, a lot of things that we are seeing globally today are some things which we have not seen before. These are things where, economists have also got it wrong, even central banks have got it wrong. So to that extent, we don't want to get into forecasting all these things. But what we know, or what are the statements of facts, are that one is that inflation in US is coming down. That's a statement of fact. That for last 2 years, inflation was one of the biggest challenges that US was facing, and as a result, the entire world was facing. I think there the data points are very clearly showing us that inflation on an incremental basis is coming down. So that is a statement of fact. The second statement of fact is that in case of US, the US consumer, which is one of the biggest driver of US economy, his net savings have also started to come down. So for last 2-3 years, US consumer used to be a big driver of US economy, and to a large extent, US is world's largest economy. So that, once US does well, then lot of the entire world then tends to, do well. And so the key driver of US economy, which is the US consumer, his net savings have already started to come down, which means that while we don't know whether, there will be recession or whether, it will be a shallow recession or a deep recession or whether there will be no recession, but what we know for sure is that next year or in the coming times, US economy will slow down and inflation will also slow down, because these are the two things which are happening as we speak, and there is no reason to believe that, something else will happen. The other thing which, textbooks have taught us, or the way we have grown, we have learned in economics, is that debt by nature is deflationary. Now, what do I mean by that? See, before COVID, the biggest problem that the world had was that the world had too much of debt. So that was a challenge that, we all were discussing, that, we were in a deflationary era. And whenever we used to discuss, we used to say that this world is facing deflationary challenge. And why deflationary challenge? Because the world had too much of debt. Now, when COVID happened, every country in the world saw it as an unprecedented challenge, and they all wanted to react to that challenge, or they all wanted to respond to that challenge. Now, how did world respond to a challenge of COVID? So the world added more debt. So for a world which had debt as a problem, to solve COVID problem, you added more debt, right? So which means that if debt was a problem and because of that deflation was a threat, now you have more debt, right? And if you have more debt, then what is the end game? The end game once again is deflation. And why deflation? Because if I take one housing loan, then my consumption will come down by a certain percentage because I have to repay. I have to repay in the form of an EMI. If I take two housing loans, then it will create further pressure on my consumption because now I have to pay two EMIs. So the moment my consumption goes down, demand goes down. If demand goes down, then companies lose pricing power. If companies lose pricing power, then deflation becomes a threat and not inflation. So one thing that is very clear about global macro is that whatever journey we are into today, so today, people might be worried about inflation, people are worried about energy prices, people are worried about host of different things. But what is very, very clear from a long-term perspective is that from a long run or from a long-term perspective, the world macro is headed towards a deflationary era, which means that the 5% interest rate that we are seeing in US today, beyond a point, the country will not be able to absorb such a high level of interest rate because the debt servicing then becomes a challenge. So why is it then, US has been doing well? Because this interest rates have risen from last 1 year onwards now. Almost more than 1 year interest rates have been high, right? So why is it that, US economy has still continued to do well? That is because of three reasons. Number one reason, if you see these high interest rates, first of all, mortgage is like 3/4 of the US household loan, and the floating rate mortgage, whereby interest rate goes up, is only 12% of mortgage loans, which means that a lot of US consumers are still paying old rates. Their rates have not been revised upwards. If your rates have not been revised upwards, then there is no challenge to you today, right? So that is one reason. The second reason is that US consumer was having excess savings during COVID. So even if he wanted to consume, there was extra savings which was sitting in his balance sheet, which was allowing him to consume more. So there was no reason to take debt. And if there is no reason to take debt, then there is no question of being impacted by higher interest rates. The third reason why the cycle is, prolongated and why people are getting it wrong in terms of slowdown is that today, if you look at the entire increase in debt that happened post-COVID, it happened at central bank's balance sheet and it happened at central government's balance sheet. Generally, if debt increase happens at your balance sheet or mine's balance sheet, the impact is immediate. Why? Because we cannot print money, right? If we take debt, then we have to repay or we default. If central banks take debt or if central government takes debt, they need not default. They can print money, which can be inflationary. That's a different challenge to deal with. But their ability to sustain higher debt is far, far superior than households' ability to or a corporate's ability to sustain higher debt. Post-COVID, the important thing to remember is that the increase in debt has happened at government balance sheet. So I think in nutshell, the key conclusions that we need to, draw about global macro is point number one, this is an era where we are in an uncharted territory. So please don't believe anyone who says you that, next year US is going to have a very massive recession. I don't think he knows, because, this is an uncharted territory. If somebody is telling you that everything will be fine next year, nothing to worry about, I don't think he knows, because this is uncharted. So it's a futile attempt to, try and predict something where we have continuously gone wrong. So the better thing to do is that if we are creating a portfolio, it needs to be balanced enough and it needs to be diverse enough that if there is a recession, there should be something in our portfolio which protects us. If there is no recession and if things are fine, then there should be something in the portfolio which adds or which creates wealth for us. And I think diversification and having a balanced approach, that's the only thing that we can do, which means that we are preparing ourselves for all kind of eventualities. Whenever you are in an uncharted territory, the best thing to do is to prepare for all kind of eventualities, right? Rather than trying to predict what will happen. When it comes to India's macro or India's, economic cycle, same word can be used to define India as well, which is uncharted. Now, how is India into an uncharted territory? In my own limited experience, I have seen an era where entire world was doing well and India did well. Go back to 2002 to 2007. Lot of people, say that this cycle is very similar to 2002 to 2007. 2002 to 2007 was the last period where India as a country did really well for a block of almost 5 to 6 years. Many people say that this is very similar to that. I agree. There are a lot of similarities. But there is one big difference. One big difference is that during 2002 to 2007, all the countries in the world were doing well. Sub-Saharan countries were growing at almost 15-20% plus. So the point is that it was an era where everybody was doing well and we also participated. We have seen periods where world has done well, but we were struggling. From entire 2010 till 2020, from an Indian investor perspective, we can say that it was like a lost decade. Why? Because there was no earnings growth. There was hardly any earning growth. Our balance sheet of banking sector was getting repaired. Our corporates were actually in a deleveraging mode. Government was also trying to control fiscal deficit. So in general, India was not experiencing any kind of cycles. See, generally what does leverage do to a country? Whenever a country is in a leverage mode, which means that more and more people are taking debt, it creates an upcycle. And whenever people are trying to reduce debt, it creates a down cycle. What were people in India trying to do? Banks were trying to basically, repair their balance sheet. Corporates were trying to deleverage. So as a result, for those 10 years, we did not have any strong earning cycle. But many countries in the world were doing quite well during that time. And we really had a very bad period, 2018 to 2020. That was just pre-COVID period. That was the time when, IL&FS went down. Some of the banks, NBFCs in India also struggled during that period. And that was the time when actually entire world was doing okay. So we have seen, episodes or periods where world was doing well and we were not doing well. We have seen a period where world was doing well and we have done well. Our early recovery post-COVID also coincided. So India's earning growth started to strengthen immediately post-COVID. But that was true for the world as well. Entire world there was a strong earnings recovery and India also participated. First commodities went up, so Indian commodity companies did well. Then IT sector experienced a boom. India has a decent IT sector, so that has also participated, right? So our initial, signs of earnings recovery once again matched with global recovery. So there was a global reflation which was happening and India also participated. This is last 12 months are probably the first after many years where world is now not doing well and India is doing well. And that once again brings us to uncharted territories. That for many years we have not seen that, we have not experienced that. Which means that there is a question mark that comes to mind that can this sustain? Right? See, because till the time whatever well we have done, an assumption would be that markets have already priced that. If you want to do well from here on, then it is important that India continues to sustain its outperformance. Now today if you see, in terms of expectations, This is the earnings growth of CY20, that is FYO 23 to 25 in terms of EPS CAGR. Where is India? India is right at the top, right? So there is a huge outperformance that is being expected from India versus so many countries. Now the key thing is that while this is good, but point number one, will this be achieved? Point number two, can this be sustained? Right? And for that, we try to identify that what are the signals, what are the lead indicators telling us, are there any red flags somewhere, or what is the source of this outperformance? Where is this outperformance coming from? Why is it that India is doing so well versus so many other countries in the world? And the simple answer to all these questions is that, see, that initial phase of recovery happened because commodity prices went up, so Indian companies participated. It also happened because, IT sector saw a boom, so Indian IT sector participated. But it also coincided with a time where Indian banking sector balance sheet had already been repaired and Indian corporate sector having already deleveraged. As a result, India today, from last 1.5 year, has entered into a credit upcycle. Now, what do I mean by credit upcycle? A credit upcycle is an period where a nation starts to add to its debt. And what do debt do? What does debt do? I told you earlier that debt ends up creating cycles. What happens when debt is added initially? It creates an upcycle. What happens later on when too much debt gets added? It creates a down cycle, right? Where are we in that cycle? We are quite early. Our leverage has started to go up only in last 1.5 year, which means that we are in an initial phase of credit upcycle. Now, what do credit upcycles do? Credit upcycles pull the economy in a certain manner. They are a huge force which create, strong business upcycle, which create strong earnings outcomes. And generally, when they start, these are powerful cycles. They can sustain, they can feed on themselves, and they generally last for at least 4 to 5 years. So to that extent, it seems to us that we are in a strong credit upcycle phase, and because it is early in the cycle, based on our past experience of credit cycles and having studied credit cycles across the world, it seems that this looks sustainable. So if there is a question as to why the cycle should sustain, because it is just too early to become non-sustainable. So when do these cycles generally break? These cycles break either when you have created overcapacity in the system, or you have created over leverage in the system, and then or there are huge defaults in the system. All these three things are not there today. So that's why these cycles can sustain. The other thing that is also happening, where Indian corporates, see, India's GDP growth is not outpacing the previous GDP growth that we used to deliver. So for example, if a country was delivering 7 to 8% kind of a GDP growth, as a country we continue to deliver the same growth. But Indian listed corporates, their earnings are far, far superior as compared to what they were delivering prior to COVID. Now, why is that happening? Because across various sectors, what we are seeing is that corporates, the listed corporates, are gaining market share at the expense of unorganized sector. So as a result, at a country level, GDP growth is same. But in the previous era, corporate universe or a listed universe was delivering earning growth which was in line with your 8% kind of a GDP growth. Today, because they are gaining market share, their earning growth is superior to what country is growing, and that's why there is this big dichotomy in India. See, if you basically talk to many Indian investors, and I'm sure you would be having some clients who would complain that our business is not doing so well. So how is it that these companies are doing so well? That is because there is this gain of market share that lot of listed companies in India are experiencing today, and this gain of market share is happening at the expense of unorganized. So that is the second theme which is driving India's earning cycle today. The third thing which is driving India's earning cycle is what we call revival of capex cycle. See, for any country to do well, consumption cannot be the only driver of growth, because consumption there is no multiplier effect of consumption beyond a point. So for example, if I buy a TV, then obviously that TV showroom will record it as a sale, but beyond that there is not a huge multiplier effect of consumption. But when we do investments, there is a huge multiplier effect. The reason is that if any engineering company, if he gets an order to execute, to set up a plant, he then has to place an order to somebody else just to execute that order. And the person who receives the order once again has to give an order to somebody else to execute the order. And when that plant or that infrastructure asset comes into picture, it enhances the productive capacity of the country. It then generates employment also. So that's why investment cycles, because they have this positive feedback loop, they are far superior. They are far sustainable. So in any country, when investment cycle revives, that is the time you can say that okay, this cycle has legs. If it is only consumption cycle, then you generally tend to worry that is it happening because people are taking more debt, because it then generally becomes non-sustainable also. But when it comes to investment cycles generally are sustainable cycle. It is because that China always focused on investment demand. They were able to grow fast for many years together. Why? Because the country was entirely focused on investment demand. In India, what has happened is that because post-COVID there was this commodity price rally, all the commodity companies earned huge cash flows. The moment they earned huge cash flows, they all announced capex. So private sector capex started showing some signs of revival. To add to that, India has been focusing on manufacturing in India for quite some time now. Government has introduced various schemes like PLI, some other incentives are being given to manufacturers to do capex. Chemical sector emerged as one more sector which benefited from China Plus One strategy. They started doing capex. So lot of new sectors started doing capex which were not doing before. See, for example, iPhones getting manufactured in India. That was not, we could not have imagined this thing happening as Indians. Tesla coming to India to manufacture cars. Once again, never thought of, never heard. So the point is that these are new dimensions to capex which are getting added very recently, which was not happening earlier. And as a result of that, today all the three engines of capex are in a upturn mode. So government continues to do capex, state governments, so central government does capex, state governments also continues to do capex. You can see this capex number: state capex, center capex, and listed corporate capex. It clearly is showing an uptrend. What was the missing number in the past? Center itself was not doing capex. Listed universe also was not doing capex, limited capex. If you see listed universe, 5.3 number was achieved in FY18. Till FY21 it had only reached 5.5. So hardly any increase. right? So neither state was doing a lot of capex, nor center was doing a lot of capex, nor listed universe was doing capex. Now all three have started firing. Because all three have started firing, there is a beginning of an investment-led upcycle in India. So the three engines of an economy, one is the investment demand. There we are seeing capex driving demand. As far as consumption is concerned, entire consumption basket is not doing well. That's why we talk about, K-shaped recovery and all those terms that we use, that entire country is not doing well. But a lot of companies in the listed space continue to gain market share from unorganized. So there it is the market share shift or value migration which is benefiting the consumption sector. And when it comes to financial sector, it is the credit upcycle which is driving. And in a way, this credit upcycle is feeding both consumption as well as investment. Why? Because when banks start lending, they either lend to corporate or households or to do government, right? So that way, there is this, positive, I would say, feedback loop or a virtuous cycle that has started in India, which can feed on itself. Because see, the more corporate earnings grow, the more taxation they will pay. The more taxation that they pay, the more government has capability to spend. The more government spends on capex, the more basically, investment demand gets generated. And I already discussed that investment demand has a huge positive multiplier effect. So the point is that India has two things going for it. One is that it is in a business upcycle, and because it's in a business upcycle, it is experiencing a decent earnings upcycle. If you see this data on the right hand side, just look at this, year on year Nifty PAT growth. There were years in between where we used to clock 3% negative. Now if you see what has happened, right, we are continuously easily now crossing double digits. So generally we tell our investors that 11-12% earning growth is a decent outcome. Right now we are way bypassing that number. We are actually delivering 19%, 20%. So the point is that there is a reasonable margin of safety. Even if there is a slowdown, even if all these things that I just told about India, it will have some global challenges, and if there is a global slowdown, we will also have our own share of slowdown. And if that happens, then earnings growth will slow down. But even if the earning growth slows down, say not 20%, but if it is 10, 11, 12%, that is fine. That is absolutely fine in terms of our ability to generate then consistent wealth, because that has been the expectation that we have set for ourselves. So we are actually right now delivering beyond our expectations. So to that extent, I think the earning cycle seems fine. We are doing well, and there is this global macro challenge which I discussed, but honestly, nothing can be done about it. Whether we can continue to do well, all the building blocks are in place for us to do well. However, there are two challenges that we should always remember, which should basically keep us grounded, and meaning that we are not entirely decoupled. We should not assume that India is decoupled from the rest of the world. There are two reasons why we cannot decouple. One is that there is this decent portion of our consumption demand which is linked to IT boom. IT sector actually experienced a big boom post-COVID. It did well, and there was this associated consumption boom, right? There was this year in India where in Bangalore or in any IT kind of a center, people used to change jobs every second month and at 25-30% pay hike also. This year IT companies have stopped hiring. So there is this big change, right? So that will have its impact on consumption. The second thing that we should remember is that for any country, mathematically speaking, investments is equal to savings plus deficit, which means that what is India trying to do? India is trying to enhance its investment demand. India is trying to spend more on investments. So on left hand side of the equation, if you want to spend more, which is you want to spend more on investments, how do you fund it? So you fund it by enhancing your savings, right? But savings are not going up because inflation has, stuck consumer hard. So his savings are not matching that. Your savings are not matching the growth that is required in investments. So then how do you fund it? You have to fund it from abroad. That is nothing but deficit financing. That is what India does, right? India is a current account deficit nation, which means that to fund our growth, we depend on external capital. Now, till what time you get external capital? Till the time you are being seen as an outperformer. So that is a necessary condition. That generally people will be more willing to fund you or your growth when you showcase outperformance, right? So that is happening. But this is a necessary condition, but not a sufficient condition. The sufficient condition is that the world macro should remain the way it is. Now see, suppose if markets are down 10%, both you and me will try and identify outperformers, right? Because that is the natural tendency of people. When they see a risk or when they see something, going down, but it is within their expectations, which means that next year, if there is a slowdown, which is within everybody's expectations, then I think people will be fine. India might actually end up being a beneficiary because people will search for outperformers. And if people search for outperformers, then India will look far, far superior. But what if markets are down 60%? Right? If that is the case, then people stop looking. Right? Because at that point of time, only cash helps. So the point is that people will look at India positively till the time they don't have fire in their own house. But if things really go very bad globally, then our ability to fund our growth also becomes a challenge. So the point is that if we want to do really well, then we have to pray that the world does okay, neither very great nor very bad. If it really does very well, then our outperformance goes down. And if it does very, very poorly, then our ability to fund gets challenged. So I think the current condition where everybody is confused globally, that actually is the best scenario for us. That if this kind of uncertainty continues, then India will shine. And if India shines, then we will continue to outperform. So I think that is where I would leave as far as the I will sum up the global macro. So I think global macro once again is uncertain. But as I told you that because India is doing very well, this kind of uncertainty is not so bad for us because people will search for outperformers. We continue to outperform. Because we are outperforming, we should ideally do well, which is why we have to be constructive. So today we are in a situation, if I were to tell you 10 if I were to highlight 10 wrong things that are happening in the world around us, it's very easy for me to do that. At the same point of time, if I want to tell you 10 good things that are happening around us, it's very easy for me to do that, which means that we are in a zone where everything can be easily justified. But I think if you really dig down deeper, then what we realize is that at this stage of the cycle, while we are in uncharted territories, there are more reasons for us to be constructive as Indian investors on India than to be negative. Why? Because we are in an upcycle, and we are at the beginning of an upcycle. The other thing that is also happening about India is that it's not only Nifty growth. We have not put the other indices growth here, but it's not only Nifty PAT growth which is strong. Our broader market index earning growth is also strong, which means that not only large cap companies are delivering good earnings in India, even mid caps and small caps are delivering very robust set of earnings. If that happens, then we are actually in a broad market earnings rally. It is not only a strong earnings cycle, it is a broad based strong earnings cycle. And if that happens, then your options to invest actually increases. Earlier in India, there was a period where only large cap used to be investable, and that too mega caps. Today that is not true. Today, the number of investable companies, and what do I mean by investable companies? So companies which deliver decent ROE, companies which deliver decent growth. That 20 company list has now become 150 to 200. So that's a vast number of companies which are doing well in India, which means that today as investors, we should not only be willing to consider large caps, but we should also be willing to look at mid caps and small caps as a good investment option. So once we have decided that, we can be constructive on markets, although, there are these risks for which, as I told you, the only way is to prepare for those risks. And for that, we need to be more balanced in terms of our, approach. But once we have decided that we want to be constructive, then the key question is that are the current valuations attractive enough? Where if I invest even a lump sum investment today, then will it make sense? Is my risk reward really favorable? See, for that you just have to look at valuations, and you have to compare it to our past. As you can see that large caps in India specifically, their entire premium has vanished. This is basically September presentation. Post that there was 5% correction in large caps, right? So there was this 8% premium that was there in September, which has also vanished. Now imagine that valuations are near your 10-year average of large caps, right? Earning growth is significantly higher than long-term average, right? So this is a very unique situation. It's only because global macro is so uncertain. You are getting this kind of a situation today, where earning growth is actually higher as compared to past. More and more number of companies are doing well as compared to past. The country is in a credit upcycle, but still your large cap index is available at a valuation which is in line with long-term average, which tells us that if I am an investor today, then at least in large cap strategies, whether it is a large cap index fund or a large cap actively managed fund, or any flexi cap strategy which is large cap biased, these are no-brainers today. I mean, valuations are also attractive, growth is also reasonable, and even if the earning growth slows down, this 20 will become like something like 10, 12, which is also fine. Today in last 2 years, Nifty has hardly delivered any returns, and that's why the PE multiple, if you see, I mean, in September 2021, we were at a huge premium, right? From there, the premiums have shrunk very sharply. So to that extent, valuations today, specifically when it comes to large caps, is very, very attractive. So large cap investing, whether it is once again through a large cap fund or through an index fund which is large cap index, or through any flexi cap strategy which is large cap biased, or even a value strategy which is large cap biased, anything which has a large cap biasness to it, actually one can do even lump sum. If you do lump sum investing, there is a very high probability that from a long-term perspective, you will make very decent returns. As far as mid and small caps are concerned, they are expensive as compared to large caps. However, they cannot be neglected saying that they are expensive, because their underlying run rate of growth is also superior as compared to large caps. And I told you that India is in a credit upcycle. Generally, if country is in a credit upcycle, it gives opportunities for more and more companies to do well. And if more and more companies do well, then even mid caps and small caps cannot be ruled out. So while their valuations are expensive, because valuations are expensive, maybe lump sum is not making sense today. But if you are investing or participating in mid caps and small caps through STP or SIP route, then I think that's perfectly fine. You can continue to do that. There is no reason to worry, because earning growth is extremely supportive. Earning growth is extremely supportive. And what does a good earning growth do? It creates huge margin of safety. See, why has Sensex premium come down in last 2 years? Has market come down? No, market has not come down. It's earnings which have gone up. Because earnings go up, your PE multiples automatically come down, and because PE multiples come down, valuations automatically become attractive. So because we are in a market where earning growth is strong, a 5% correction in 1 year creates almost 20% cheaper valuations, because 15% is the earnings growth. Even if markets do not go anywhere, they still become attractive. Why? Because earnings have gone up. My point is that we are in the midst of a credit upcycle. There are no doubt, global macro uncertainties. Even from an India's perspective, we are to some extent into uncharted territories. But these all are worries. If you worry too much, then sometimes you will miss the journey. I think the journey is strong enough for us to participate, and starting valuations are attractive enough for us to consider. Large caps so definitely can be considered even as a lump sum investment opportunity today. So with that, I'll close my presentation. If there are any questions, either with respect to markets or with regards to anything else which I might have not covered, I'm happy to answer. Thank you.
Manner. We very well understand the points that you highlighted in terms of the building blocks that we have very well positioned as far as the economy is concerned. And we also very well buy the fact that we are in a credit upcycle, earnings upcycle, as well as a capex cycle. Two very important challenges that you highlighted as well. So another challenge that we come across whenever we interact with so many of our investors, and I'm sure many of them would be having the same kind of question in their mind, is the upcoming general elections next year. We are quite hopeful that the present government continues and comes into power so that all the policy framework that has been there in the last decade gets a momentum and continues. However, there is an element of uncertainty, and even many of the renowned market strategists, Mr. Christopher Wood has predicted a sharp correction if the present government does not come into power. How do you take that, and how should an investor approach this uncertainty as far as investing presently is concerned?
So it is like, so election related uncertainty, on the face of it, it looks like it is our version of US recession, right? So it will seem that India has gone into recession if this current government, at least from equity stock market perspective, I think, or from equity investors perspective, people may start assuming that ab India ka kuch nahi ho sakta, right? So that's a very general or very logical thing to think. But see, we have to remember that, we have been ruled by various governments, right? 1980 से सेंसेक्स का जर्नी स्टार्ट हुआ था. You yourself can see that we have been ruled by governments which have been way worse than what we can imagine. Not long ago, we used to talk about, policy paralysis, right? Right now we are talking about, over activism by government in some areas, right? And not long ago we used to talk about policy paralysis. So the point is that, governments do come, governments can change. In a democratic setup, you cannot predict the election outcomes. While all of us would want continuity, but, we never wanted COVID. but we encountered COVID, right? And now, after having seen COVID, all of us would have learned something. But definitely, we are not poorer than what we were prior to COVID, right? So the point is that, see, we have to remember that capital markets are very ruthless by nature, okay? So generally what happens is that on the first and the second reaction on such an event, generally is that there is a broad-based correction, right? So that's the first reaction. From third day onwards, markets try and identify that, okay, who are the potential winners under this government setup? Because we are capital markets, we are very ruthless. We don't love anything, we only love money, right? We only love earnings. So the point is that people start then analyzing that, okay, under this setup, which are the companies that make sense? And they start doing well, right? Which means that mutual fund ranking changes, right? But what if an investor is well present, across different mutual funds? What if an investor is well present across markets? What if an investor is well diversified across, equity and debt? Then he generally does not suffer. The beneficiaries of the current cycle might have to undergo some set of challenges, and they will have to, learn to adapt themselves to a new setup. But in general, economy, there are always going to be winners and losers. In the current, we are now used to this government's functioning. But if you recollect, for the first 5 years of this current government also, we all were also wondering that, is really, the promise that was being made, is all of that being delivered or not? Now, after seeing, entire 10-year period, we all have got used to certain way of working, and we are very comfortable, under that way of working, and that's why we don't want the change, right? But, change generally is not always bad. Sometimes, it can bring something different, which today, all of us cannot think. So it's not always bad. That is one. Second thing is, change is something that we have to be ready for. That's why even if you look at, our own portfolios today, we are not playing full offense. There are certain themes that I spoke about, but we are not 100% exposed to those themes. We have deliberately kept some companies or some exposure in our portfolio just to ensure that tomorrow if cycle changes, then this should act as my defense. So I think as an investor, you should always be prepared for any kind of eventuality, and even if that eventually happens, life goes on. As I told you, we have seen governments which have been far worse than what we could have imagined, and still our country has done well. I think just because government changes, from a long-term perspective, things do not change dramatically. Yeah, so the direction of change can be different. Instead of basically an urban-based consumption economy, or unless instead of premiumization being a key story today, it might be rural India which might become the next theme. That's fine. As a capital market participant, I'll get sufficient companies even there. So ranking can change, but I don't think beyond that, from a long-term perspective, one should. I don't think India, India's outcomes are all about government. Lot of companies, lot of sectors in India, they've, for example, this entire IT story, it has nothing to do beyond a point with government, right? IT as a sector has become like a staple as far as way of doing business is concerned. Everybody has to invest into IT. There is no choice today, and that theme can continue, no? Right? So I think there can be reaction, but I would say that will become even a more attractive buying opportunity, provided you have the right mindset at that point of time.
Very rightly said that the markets are so ruthless. The reason, just what I remembered out of the words that you used, that when Hamas attacked Israel, all the global markets went down. US markets even went down, but a bunch of defense stocks went up.
Yeah.
So there people saw an opportunity that the US is a 45% supplier of defense equipments and armaments in the world. So there they saw an opportunity. So as you rightly said, interest in identifying that which sectors or which stocks now to be positioned. That's the way things can go on.
So people will have to adapt. So if there is a change, there has to be an adaptation. But I still think that life will go on.
And a well-diversified portfolio across different asset classes, different asset management companies, different kinds of sectors will be the key to create long-term wealth.
Correct.
These effects would be momentary, as you
Correct.
rightly mentioned.
Correct.
Right. Diverting slightly from the subject of equities, we very well know that gold has outperformed and delivered decent returns in the past 1 year. Even as we discussed, the fixed income interest rates are quite good enough. How do you think an investor should approach asset allocation at this point of time, going further to have a well-diversified portfolio across different categories?
See, gold. So generally, when I think about gold, the only thing so gold, first of all, has no earnings, right? So there is no way to decide that whether it is attractive or unattractive. Gold's attraction has always to be evaluated with respect to some other asset class. So it's only a relative attractiveness that you can judge for gold. There is no absolute attractiveness or unattractiveness. For example, equities, you can say that this is cheap on an absolute basis. If markets basically become 10p, then you can say that, yeah, this is cheap. There is 10% earnings yield, right? But for gold, there is no such, earnings yield to work on, which means that you have to view gold and its attractiveness has to be judged versus some other asset classes, right? Now, when you think about gold, so one is that, see, gold, I mean, our way of looking at gold is that it's always a hedge in your portfolios. So you don't need gold because you expect it to outperform. That is not the reason to buy gold. The reason to buy gold is, I don't know how many people, were able to see gold price movement actually happening during COVID. That is from 1st, Jan 2021, or 1st Jan 2020 till 31st March 2020. Gold as an asset class was up 17%. Your equity as an asset class was down 25-30%, and gold went up 17%. If you had gold in your portfolio, it acted as a hedge. So the thing is that gold plays a very good role. It's a fantastic asset class if you want to have a hedge in your portfolio, right? On its own, you don't want gold to do well, because if gold is really doing very well, then something is wrong somewhere else. So you want gold to basically, just beat inflation, which what it, tends to do over a long period of time. On top of that, you get dollar returns. For a country like India, whose inflation is higher as compared to US inflation, your currency generally tends to depreciate over a long period of time. So your dollar returns generally are superior as compared to rupee returns, right? So to that extent, you get that extra bit of, returns. But from a long-term perspective, I think one is that gold should always be viewed as a hedge, not as an investment class to invest in and try to benefit from a, short-term momentum perspective or something like that. Second thing is that gold is always a must in your portfolio. See, the reason is that, last 10-12 years of our own investment, careers, what we have seen is that the role that, central banks are playing in terms of driving the direction of the markets, it's now being taken at another level. I mean, never in the past we used to give so much importance to liquidity driving returns. Always in the past, we are used to saying that earnings drive returns. So if you have decent earnings growth, you will get decent returns. But nowadays, lot of analysis worldwide happens into what is the central banks, or what are the central banks going to do with their liquidity? When are they going to start cutting interest rates? When is Fed going to stop doing QE or QT? Right? Sorry, right now they are doing QT. So when is the Fed going to stop to do QT? When will they get into QE mode? Now, why are those things so important? Do they have anything to do with earnings? Beyond a point, no. But are they really become important? The answer is yes. So the point is that the size of central bank's balance sheet has increased so much that any change of action by them, becomes an important driver of the market. So which means that while all of us might feel that we all are in control, and I might feel that, okay, if I bought an entity whose earning growth is decent, which means that it is going to create wealth, the fact of the matter is that in the entire world, there are these central banks which are at the front seat and driving everything else, right? And beyond a point, they all are in uncharted territory. So they also don't know whether, at the end of the road, whether there is a cliff, there is a mountain, there is good road, bad road, nobody knows. The problem is that for every problem that the world has faced, an indebted world ends up creating more debt. And if that is the, that is the course that we all have, decided that is the best course for ourselves, then you always need a hedge. And if you always need a hedge, then there is no better hedge than gold.
And everything where one needs to take advantage of these high interest rates in terms of increasing exposure into debt or fixed income instruments or investments. These are the equities, because now if as the world at large is predicting that there's a pause in the US, and now if there is quantitative tightening, so say QT, so that would eventually lead to certain kind of fall in the interest rate, which will give capital gains on a fixed income instrument.
Correct.
And also the rates of interest at which one can lock the rates on the higher side. So does it make some sense to have a little more portion of your asset tilted towards fixed income instruments to a certain extent as of now?
See there, so let's imagine a scenario where interest rates go down. Okay. If interest rates start going down, then obviously they create an immediate capital gain on your bond portfolio, right? But we have to remember that it is that scenario when generally, globally things will start looking good, right? There will be a earnings upcycle which will be predicted. India is already experiencing an earnings upcycle. Okay. Our problem is our multiples are derating today, specifically on the large cap side. Now imagine a scenario that interest rates globally start going down. Your earnings growth is anyways decent. It becomes believable, because right now if you are at 20, because world is basically doing poorly, you are worried that was this 20 will happen or not, right? But imagine that you are at 14, 15 and the world now starts looking better, which means that your outlook also improves. On top of that, if interest rates go down, then cost of capital goes down. So P multiples also temporarily can go up, right? So in such a scenario, on an absolute basis, while debt is very, very interesting today, no doubt, because if at the peak of the interest rate cycle, debt generally becomes like a no-brainer, right? But I would say that at this stage, honestly, you should load up all the possible, investments that you can load up, both into large cap equities and duration debt from FDs. So actually, I don't think that equity and debt today are competing with each other. Both are attractive. Debt is, I would say, having more margin of safety because downside obviously is limited. But it also has a cap in terms of absolute upside. Equities have less margin of safety because there is a decent downside that is possible, but then it also has a higher upside. And that's why I would not say that, both are hugely competing with each other. I think both are attractive. For me, the most unattractive instrument at this stage seems to be FDs. Because there, if you are getting even 7.5, I mean, I think both equity and debt can, easily beat that over next 2-3 years. So that is how you should view it.
The moment an investor's portfolio scales beyond a certain size, say to a certain, the first investments come into large cap, large and mid, and flexi cap and multi cap and all those kinds of things, and eventually mid cap and small cap. But then when a portfolio scales up to a certain level, we advise investments into sectoral funds, certain sectoral funds. 4 kinds of sectoral funds which we normally prefer. One is banking, financial services. Another is technology. Third is pharma and healthcare. And fourth is infrastructure.
Okay.
So what could be your view and take on each of these sectors or sectoral funds, where in the coming times, which would do better, or something where India is positioned in a better way?
See, I mean, the challenge, today in trying to identify a sectoral fund is basically is that, then you are taking a view that entire sector will do well. Because only then the sectoral fund actually, works brilliantly, because sectoral funds generally do not depend on stock selection. They depend on the, sector allocation, in the sense that that sector does well, and that's why, that fund does well. Now, the problem in, trying to identify sector allocation at this stage is that, so, I mean, from a fundamental perspective, financial services is the most attractive from a valuation perspective. But the fact of the matter is that in US, the banking sector out there is not trading at a 1 or 2 year low versus its historical average. It is trading at its lifetime low since 1941. So effectively, US investors have not made money in financials. So last 15 years, banking sector market cap in US has not gone up. So financial investors have not made money in banks in last 15 years in US. Now, if that is the fact of the matter, then if you just go by valuations, which is definitely cheap today, this is also the risk that you are facing, that see, cheap can become cheaper, right? So just because if something is cheap, should you buy it? So that is one worry, that investors' experience in this sector has not been great for last many years. So, and as I told you, generally, I never used to care about liquidity and demand supply, but unfortunately we live in a world where past experience has to be taken into consideration. So that is one caveat when it comes to financial services. When it comes to infrastructure, the caveat is that the sector has already done quite well for almost 3 years in a row now. So one, it is a momentum sector. Second, valuations are expensive. It's difficult to find a good infra business at attractive valuations today. So while there is a decent upside earnings potential here, but a lot of it is also priced in. So third is the pharma and healthcare. Now, this is also one sector where valuations are attractive. But there the only challenge is that, see, there are companies, in India there are 2 types of large pharma companies. One is which are domestic focused, the other is which are global in nature. In areas where companies are global in nature, they are still, generic companies by nature, largely, many of them. And that has its own set of volatility. As we speak, some of these companies are experiencing an upcycle. But the moment there is a down cycle, then these companies tend to struggle. So it is not a sector. See, what we saw from 10 to 15 in pharma was that some of these companies became much larger in a generic pool which itself was growing. Today that generic revenue pool in US is not growing, which means that you can only gain market share in 1 or 2 years and do well, and then once again in 1 or 2 years you lose market share. So we have to remember that you are not participating in a growing pool anymore, and a lot of companies face this challenge. The other thing is that if you are exposed to US, then your ability to grow faster than nominal GDP of India also gets compromised, right? Because US nominal GDP is not growing as fast as India, right? And if a company in India does not manage to grow faster than India's nominal GDP, then that is not viewed as a growth company, right? So there, while valuations are attractive, the growth itself from a long-term perspective is questionable, and it is cyclical also. So it's not such a clear-cut case of saying that okay, because pharma is attractive, go and buy it. Now IT is the only sector where I would say that there is a clear-cut case of saying that okay, top-down is attractive. IT, according to us, has become staple. It's a way of doing business. It's now a survival thing. So to that extent, there are sufficient tailwinds to the sector for it to do well from a long-term perspective. But there, the biggest challenge that at least we face as investors when we invest into IT names is that for some reason this sector has the least earnings volatility and the highest stock market price volatility. We have experiences where a 4 to 5% earnings downgrade in an IT company has led to 33% stock price correction, right? Whereas consumer companies in India, their earnings they get downgraded by 20%, and the stock price fall will be like 4%. So the point is that while IT can be an attractive sectoral fund from a long-term perspective, but it will have its volatility which might be worse than a small cap fund. So there will be years when it will give you brilliant returns, and then there will be years where it will take away a lot of your returns. Now right now we are in a cycle where we are in mid-cycle, so it's not as attractive as what it was last year from a valuation perspective, and it is not as unattractive as it was from a valuation perspective the year before that. I think the year before that it was clearly very unattractive because valuations had re-rated quite sharply. Last year it had become very attractive. This year actually it's somewhere in between. So my point is that instead of trying to benefit from a sectoral fund, I think we are better off basically creating portfolios of winners across various sectors. That I think is a better strategy at this stage.
Lot of enriching insight. Any questions from present? Most welcome. Are there any questions, please?
Thank you so much, Mr. Ganatra,
Thank you.
for being present here and coming all the way from Mumbai to address us. It was a pleasure having you. In fact, we had the pleasure of having you as well in 2019, and we look forward for many such sessions ahead.
Thank you.